All my previous videos talk about the New York Open strategy, which means we trade after 9:30. However, there could be some opportunities before the New York Open, which is pre-open or even overnight. So in this video, I'm going to talk about the strategy for the pre-open, especially at 8:30. The movement at 8:30 can be classified into two categories. The first one is the economic event driven. The second is the non-economic event driven. First, let's have a look at how to trade when there's an economic event at 8:30. Take this chart for example. This is 8:30. So apparently, this 8:30 there is an economic event that's the US CPI. And then upon the 8:30, we can see there's a huge breakout bull bar, which seems to be a breakout strategy. So if we trade the breakout strategy, we can wait for the pullback and the signal bar. Here's the pullback with a doji bar, with a bear bar here, and then the next bull bar can serve as the signal bar. Then you can enter after this bull bar finishes. This 8:30 breakout strategy is exactly the same like the 9:30 open strategy. So you trade for the pullback and then trade for the second and the third leg. However, one thing special about this economic event driven strategy is that you can see here the market goes up a lot with multiple small legs, and then it goes up, never goes down. So there are a lot of trading opportunities for swing. This is something specific for the 8:30 economic event driven strategy. This is a perfect swing opportunity because after the pullback, you can see the market continues to go up. There's no big pullback. The bear bars here are very small with the doji bar, and then the bull bars are bigger and bigger. So right after the New York Open at 9:30, it continues to go up. Even around 10-11 here, there are two small pullbacks, but you can see even though 3 consecutive bear bars here, 4 consecutive bear bars here, but it doesn't reverse the whole uptrend a lot. So that's why this uptrend is very strong, and then you can swing until the end of the day. But one thing to remember is not all the economic events at 8:30 will trigger big trending, and even for the same economic event, it won't trigger big trending each time. So you need to kind of study the historical data to understand the pattern of each of the economic event and the trading opportunities accordingly. Let me use some other examples to show you why. So this chart, there's an economic event of the US initial jobless claim at 8:30. We can see that right after 8:30, there's a breakout like the other economic event, US CPI, and then we wait for the pullback and then trade accordingly. So here's a small pullback with a doji bear bar, and then the next bull bar can serve as the signal bar. Then you can enter after this bar finishes. After that, the market goes up a lot, and you can see it goes up straightly. It never have a big pullback. So this is a very good opportunity for swing as well, and then it goes up all the day. If you think for this US initial jobless claim, you can trade the same each time, then it's not correct. Let me show you another example. It's the same initial jobless claim here, and then with the breakout bar here, you can see it's very strong. And then next you can see these bars. Where's your signal bar? It's hard to say, because if you treat this bear bar as the pullback, the next bull bar is the signal bar. It didn't trigger. The next bar didn't trigger this bar. And then pullback again. Next bar, it can serve as a signal bar, but the next bear bar is the inside bar again. It didn't trigger. And then next time, this small bull bar is an inside bar. This one is a very good signal bar, and also we have 1 push, 2 push, and 3 pushes. So this bar can serve as a signal bar. If there's a 4th push down, then you don't want to trade and hold and watch. If you enter at this bull bar, you can see it triggered right away. However, here in the New York Open, right away it goes down. This pullback is very big with 4 consecutive bear bars, and if your entry is here, you go down to pierce your entry. And if you want to put your stop at the bottom of the pullback here, which is the bottom of this bear bar, it triggered your stop as well. So you have a loss, even though later on it goes up a lot. So this is something to be mindful that not all the economic event at 8:30 can give you a good trade if you do not trade correctly. So in this case, it's very hard for you to hold when you see this big going down. You think maybe it's gonna go to test the bottom of this 8:30 bar. So that's why there's nothing wrong if you get stopped. However, if you have a very initial stop at bottom of this big bull bar here, you could survive this pullback. But think about this, your entry is here, your stop is here. That's gonna be a lot of money to have the buffer as the stop. So I don't think a lot of a trader can hold tight to the stop at the bottom of this bull bar. Another thing is that after the pullback here, when you see this big bull bar, this bar is very good as a signal bar as well, because the tail at the bottom is big, the body accounts 60% of the candlestick. If you choose to enter after this big bull bar, you could earn some money for sure, because it goes up a lot later on and then it didn't go down too much. Let's have a look at another example, which is still the US initial jobless claim. At 8:30, you can see that there is a bear bar, doji bar with tail at the top and the bottom. The body is right in the middle. So there's no big change, no big fluctuation, and then no direction, even when the economic event comes. And instead, after 9:30, you can see the market goes sideways for a little bit and then it goes down to a break. So this you can trade like New York Open range break and retest strategy, and then you can see the market later on goes down. However, like I said before, that 3 pushes should be some kind of a benchmark for you to enter your trade. Right now it goes down. First push, bull bar. Second push, bull bar. Third push, bull bar. Fourth and fifth. There are 5 pushes here. So in that case, most of the time the market doesn't go down. However, in this case, it goes down. There's a probability. So when you see these 5 pushes, are you able to enter right after you see this bear bar here, or even you see this bear bar here? So that's a question. So if you are cautious enough, there may not be trading opportunities for you today. So to sum up, for the pre-open at 8:30, if there's an economic event, then there is trading opportunity depending on what type of economic event, and also depending on the chart itself. The second scenario is there's no economic event at 8:30. Take this chart for example. At 8:30, we can see there are consecutive 4 bull bars here breaking out. It's a breakout mode. So if you want to trade the pullback and then signal bar here, you can see this bear bar is the pullback, and this bull bar can serve as the signal bar, though the body is more than 60%, but the tail at the bottom is bigger than the tail at the top. So if you choose to trade here, the market does go up. However, what you can see is that right after the New York Open here, there are 2 consecutive bear bars going down, and then this huge tail is lower than the bottom of this pullback here. If you put your stop here, you're gonna get stopped. And even this tail is so big to test the bottom of the first bull bar here. Even though it didn't reach this, but still it's a testing. So that means if this fluctuation goes down, are you able to hold and sit tight? And even though later on it goes up, there are only 2 consecutive bull bars, and then later on there are big or huge bear bars going down. So to me, this is not a very good trading opportunity, and if you didn't take your profit at here or even at here, then you're gonna have a loss for sure. So this example demonstrates that basically at 8:30, if there's no economic event, there won't be a very good trading opportunities most of the time. Another example to show there's no economic event. So basically you can see there are trend lines at the top and at the bottom. This seems to be a wedge, so we are waiting for the break. You can see at 8:30 the market seems to go down to break the bottom trend line here. So it seems to be breaking down to the downside. However, right after the New York Open, you can see it reversed, and then instead it breaks the top trend line. So if you trade here at 8:30 to the downside, you could have a loss. However, if you wait until the New York Open to see the real volume here, you can trade upside and then gain a profit. So this is also a very good example that why you should not be trading 8:30 without an economic event.